Portfolio manager at Penn Mutual Asset Management. Thank you very much indeed for joining us. And that would seem crucial, okay, what CEOs say about the consumer and pessimism on that front.
You're right, Andrew, and thanks for having me. So yeah, if you think about it, we are all stewards of capital, whether you're a portfolio manager, whether you're managing a country, or whether you're running a country, or whether you're managing a company. And so where we're spending a lot of our time, because there is so much uncertainty, and everybody keeps saying that, but what do you do about it? And what we do about it is to listen to companies. And so over the past 2 days, for example, our team spoke with 10 different CEOs just to try to get their tone on the market, because again, companies want to make decisions over the next few decades. They don't want to make a decision over the next year or two or quarter or two. And so we're trying to discern and get through, okay, where do we see visibility and where can we find the visibility and stability and then have that benefit our shareholders? So that ultimately has been our goal through this uncertain period.
I know we've been talking a lot about the Fed this week, perhaps ad nauseum, but give us your take. Do you see the possibility of interest rate reductions?
Feels that way. So the way we look at that, if we guessed at it, we would probably be wrong more often than not. So we're trying to gauge what the market is telling us. The market is telling us there should be about 66 basis points worth of cuts in 25, despite what a lot of the Fed governors are saying. Because again, there's a lot of uncertainty there as well. The consumer may be falling a lot faster than many people have expected. The Fed has projected slower growth, but yet more persistent inflation. And so is stagflation now a possibility? So again, all these factors are difficult to ascertain. We do think by the end of the year there should be some cuts, or at least that's what the market is telling us for sure now.
You do see a shift in the financial markets right now, including international stocks coming into favor among U.S. investors anyway.
And if you think about the concentrated markets, that's all we talked about probably for the past few years. And this rotation has been absolutely massive. We went from U.S. to international. We went from big tech to just about every other sector potentially, value sectors, for example, value versus growth. And so these rotations have been massive. They've been important to watch because the valuation had gotten so high and concentrated in the Mag 7 names. The Mag 7 traded at a premium of 80% to the S&P back in 2021. That's now been reduced to 23%. And again, that money has gone somewhere, and it's gone overseas, and it's gone into Chinese stocks, and it's gone into value sectors. So we paid close attention to that concentration. We tried our best to avoid it, and then to filter into some of those areas that are benefiting today.
What is your take on bonds? Are you attracted by U.S. 10-year bonds right now?
Sure. So we did have a decent allocation. So we were a little bit barbelled. We had a decent allocation to some of the long end from the 10-year all the way out to the 30-year. One of the issues that we saw, again, with the potential for slowing growth, that could be good for bonds. There's been more of a flight to quality than we ever would have anticipated more recently, and we are seeing that in the bond market today. So the last part of the bond market, now we like credit a lot, but one of the things you really have to be careful about today now is spread widening. It's just starting to widen now after holding in at all-time or close to all-time tights for a very long period of time. Demand for credit is almost insatiable, but now we're going to see a challenge to that potentially with lower growth.
What about tech stocks? They have come off their highs, obviously. Are you tempted to start buying into some of these Mag 7 companies? Because many of them are still growing rapidly.
Great question. And so we haven't purchased any of the Mag 7, but I will say there are a lot of companies within tech that should benefit from the CapEx, the massive CapEx spending that we anticipate over the next 3 to 5 to 10 years. And so, yes, especially in mid and small caps, there seems to be a lot of value. They were already cheaper than the Mag 7. And now, if you just look at some of the names getting even cheaper, if you can find good balance sheets, companies that I would say maybe have some visibility and a near-term catalyst, those are the ones that we tend to favor within tech. Now, the Mag 7, to your point, they've done really, really well over a long period of time. But look at Micron's results, for example, today. The market is being incredibly nitpicky. Micron did really well, but now they're going to nitpick on the margin maybe. And so we're seeing that excitement just come out of those names. And that could take a while for it to reverse and come back.
What about consumer goods? Are you tempted by sectors that might be seen as defensive, such as food retailing?
So as a contrarian, we saw those names be kind of left by the wayside over the past year or so, and we did gravitate a little bit more towards staples, a little bit more towards certain situations. So there's a couple interesting buckets of names that usually trade at big premiums within the value sectors. One of them is water utilities, and one of them are some pizza companies, for example, or more fast food companies that are smaller cap in nature. And some of those do look attractive here, and those were the ones that we gravitated towards. Again, not knowing what was going to happen with big tech and Mag 7 in this rotation. They just looked historically cheap from a contrarian standpoint.
And just finally, what about the classic cyclicals, say chemicals or materials? Are you tempted at all there as a contrarian trade?
To your point, our temptation comes when those names start to fall in our buyable range or universe. And those are really tough, again, because they are fully exposed to the trade worries and the tariff talk. So I will say not at this point yet. We recognize them as being cheap relative to their own history, but I don't think there's as much visibility as we'd like to see right now. Now, of course, we may give up some gains if we do see visibility and they rally, but at this point, it just seems a little uncertain, and a lot of those names do have a little bit more leverage and debt tied to them. So we'd rather clean balance sheets at this point, more near-term visibility.
George, thank you very much indeed for joining us.
Thank you, Andrew. Appreciate it.
George Cipolloni is portfolio manager.